Chapter 15, in Part 1, we're going to cover operating leases. Now, we have certain lease classifications. Based on classifications and guidelines, we have to account for them. And we have to look at this from the lessee and the lessor's point of view. For the lessee, there is what we call a finance lease. There's also an operating lease. Now, for an operating lease, it is, if it doesn't meet the criteria of a finance lease, then it's an operating lease. But if it is an operating lease and it's over 12 months, we have to set it up as a right-to-use asset. If it's 12 months or less, usually you don't have to, and it only appears on the income statement. Now, for the lessor, there is a sales-type lease. It's without selling profit, which is a finance lease, with selling profit, which is a sales-type lease. And they also have an operating lease. In this section, we're going to go through operating leases for both the lessee and the lessor. Now, how do we figure out how to categorize these leases? Well, we have guidelines. Now, the rules for determining the types of lease is based on the following criteria. If you meet one of them, then you can either have a sales type lease for the lessor and a finance type lease for the lessee. So here we go. If there is transfer of ownership to the lessee, if it contains a bargain purchase option, that means at the end of the term, say the equipment is valued at $100,000, at the end of the term you can buy it for $10,000, that would be considered a bargain purchase if that's less than the fair market value. Long term, usually equal to or greater than 75% of the estimated economic life of the leased property. The present value of the minimum lease payments, excluding executionary costs and maintenance fees plus residual value, equals or exceeds 90% of the fair value of the leased property. The underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. Now, let's take a look at an example and walk through our rules. Now, Company A leased equipment from Company B, a leasing company that purchased the equipment for $250,000. The lease term was 2 years with 8 quarterly payments. Quarterly payments are $15,000 on the 1st, the 31st, the 30th, and the 30th, and so it's in January, March, June, September, December. The economic life of the asset is 5 years. Interest rate charged by the lessor is 8%, and amortization and depreciation is recorded quarterly. What? First you want to figure out, because we have to answer our questions, what is the present value of the lease payments? So to figure this out, we go to the present value of an annuity due. Now remember, you use annuity due if the first payment is at the beginning of the lease. Otherwise, we just use a normal annuity schedule. So now, in this case, we have to figure out what is N. Well, N would normally be 2 years, but since we're paying 4 times a year, N equals 8, because you have to take the 2 times the 4 times a year. Now the interest, we have 4 quarters because we got 4 quarterly payments, so we're going to take the 8%, divide by 4, we get 2%. So then we go to our present value table of annuity due, and we get the factor 7.47199 times 15,000, which are the payments, and that gives us a net present value of 112,080. Now we're going to determine what type of lease this is. We're going to go through our criteria. Now, does ownership transfer in our example? No. Is there a bargain purchase option? No. Lease term equals 75% of the economic life of the leased property. In this case, the lease term is 2, it's economic 5, so the answer there is no 2 because we're only 2/5, which is 40%. So no. Present value of the minimum lease payments equals 90% of the fair market value? No. Guess. The 112, which is the present value, divided by the 250 is 45%. The underlying asset is such a specialized nature that it is expected to have no other usage. The answer there is no. So, step 3. This doesn't meet any of the criteria for a finance lease, so therefore, fundamental rights and responsibilities of ownership are retained by the lessor. Lessee merely uses the equipment temporarily. A sale is not recorded by the lessor. The lessor records lease revenue on a straight line basis. Lessee records the right of use asset because it's greater than 12 months, and the lease payable at commencement based on present value of lease payments. Lease payable is considered a non-debt liability. So therefore, based on this, it meets the criteria of an operating lease that has to be treated as right of use. Step 4. We're going to go to the lease amortization table to determine how much of each payment is interest and how much goes against the principal. So, to determine the interest portion of each payment, we're going to take the balance in the right of use account times the period interest. That's what we're going to do every time. Since the payment is made at the beginning of the period, the first payment includes no interest. But the second payment would be the $112,080, which is the present value of the $250,000, which we calculated previously, minus that first payment that includes no interest, times 8% divided by 4 periods tells us our interest portion is going to be $1,942. So when we make our second payment of the $15,000, $1,942 is going to be interest expense, and the difference will go against the lease payable. So here is an example of our lessee amortization table. So again, the first $15,000 just reduces our outstanding balance of $112,080, but then the second payment will include interest. And as you notice, as we go through this, we're going to reduce our outstanding balance by the portion that is the lease part, not the portion that's the interest. And in the end, we should equal 0 at the end of the 8th period. Because remember, it's 2 years, but it's payments of 4 times a year, so that gives us 8 periods. So that shows you how you get your second one. What you're going to do is you're going to take your balance after your second payment times 2%, which is the 8% divided by 4, which tells you how much of the next $15,000 is going to be treated as interest expense. Now we're going to look at the actual journal entry so you can see what this looks like. So on January 1st, the first payment, we're going to book and when they sign the contract, it's going to be right to use asset, which is the present value of the lease payments, and lease payable, which as we make our payments is going to be whittled down to 0 at the end. And then lease payable cash would be our first entry when we make our first payment. And if you notice, all $15,000 goes against the lease payable because there's no interest because it was made when signed. Now, what about the lessor? They're going to receive cash and treat it as deferred revenue because this revenue is going to be earned over time. Now, for our next payment, we're going to, that should show, but we're going to say on our March 31st, what we're going to do is we're going to book our next payment. And if you notice, we have a portion of it that's interest expense, a portion that reduces our lease payable, and a portion that reduces our cash. And now we're going to also reduce our right of use asset that we put on the books. And we're going to reduce that by $15,000 minus the interest, and then we're going to reduce our asset, which offsets our lease payable. Now, for the lessor, they're going to now treat that payment in January as lease revenue, and then they're going to record their next payment they received on March 31st as deferred revenue. But what they're also going to do is depreciate our item. So we would take the $250 divided by 5 years divided by 4 quarters, and we'd have depreciation expense, accumulated depreciation. We have to depreciate on the lessor's books because it still is on their books. There is no transfer of ownership. Now, what about our June 30th payment? We'd go through the same thing. We'd have interest expense, cash, lease payable, and amortization expense, right of use, which remember is always the same amount as the lease payable when you're doing your homework. And then for our lessee, for the lessor, they're going to get the cash defer the revenue. Again, they treat the deferred revenue from the previous payment, and they're going to treat that as revenue from the March payment. And again, they book depreciation expense. Now, that's how you would treat it. It doesn't meet any of the criteria, but it's greater than 2 years. It has to be treated as a right of use asset. Now, next what we're going to look at is what happens if it's less than a year or less. Well, these are called the short-term or shortcut method. A lease that has a maximum possible lease term, including any options to renew, of 12 months or less is called a short-term lease. Lease by lease option to choose a shortcut approach. Lessee can elect not to recognize a right-of-use asset or a lease liability, which is more than likely what they do, and to recognize lease payments as an expense over the lease period. This is also the approach used by the lessor for lease revenue on the flip side of the transaction. So, in order to use the shortcut method, the following criteria must be met. Has a lease term, including any options, of 12 months or less, and 2, does not contain a purchase option that the lessee is reasonably certain to exercise, which would extend the term beyond 12 months. Lessee, beginning of lease, no entry. You don't have to record the right of use. And their first payment would be prepaid lease cash. Lessor, no entry is recorded. No entry record a receivable or to de-recognize an asset because the lessee does not take the asset off its books. It must depreciate that asset, record revenue when earned. Now let's look at an example. So, Company A leased equipment, $250,000, but it's only for 1 year. We know the economic life, we know the interest. Can we use the shortcut method? The lease is 12 months or less, does not contain a purchase option that the lessee is reasonably certain to exercise, which would extend the term beyond 12 months. So yes, we can use the shortcut method. So now let's take a look at our entries. So January 1st and all other lease payments for lessee. No journal to record right of use. When lessee pays the cash, it's going to be prepaid lease cash. Lessor is going to have deferred revenue. March 31st, they're going to book the expense for the January payment, and the lessor is going to record the revenue. And then they're going to record their next payment when they pay the cash for the lessor and the lessee. So that concludes how do you treat an operating lease, whether it's for greater than a year or a year or less.